Hi, and thank you for joining us today. My name is Victor Robinson. I'm a military veteran, an inspiring entrepreneur, philanthropist, an activist, and a generational wealth coach. I currently work in the financial services industry, and I've worked for endowment firms and helped other people with investments and strategies and underwriting as far as it comes to loans and mortgages. And today, I would like to talk to you about deal evaluation in the real estate market when it comes to newcomers. I have some really good information for you today, so stick in there, hang in there with us, and let me know if you have any questions. Comment below, give me a phone call or email, and we can talk about some of these things individually and walk through it with you. So today we're going to be talking about cash flow. We're going to talk about determining how much house you can afford and how much house you actually want to buy. And then we're going to look into the art of recycling capital. So let's get started. First thing, one thing that you'll hear a lot is cash flow is king. And that's definitely true in every space. So, but there are other metrics that you can also evaluate the asset or evaluate what the cash flow actually is, whether it's over time or immediately. So make sure you're looking into that when you're talking about what type of deal it is, what type of cash flow that you need, or what type of return that you actually need. You can look at some of our other videos that talk about that along those lines as well too. But let's focus on cash flow in the sense of wealth building. So you have cash coming in. Cash coming in can come in a lot of different forms, whether it be the job that you have on a daily basis, whether it be other investments that you have, whether it be stocks in S&P 500 or the active market, right? But understand that when the cash flow comes in, one of the things that you really want to pay attention to is where that cash goes back out, right? So if you have cash flow coming in and it goes right back out to expenses, or you buy a new pair of shoes, that's not really building the wealth, and it's not really contributing to the matrix of wealth building. But if you take that cash flow from the income that you build in from your job, you buy an asset, and then you push that into an asset that flows cash. So you buy an asset, it costs you $1,000, but it brings in $1,500 in cash flow. That's $500 in revenue, and you can then take it back into the cycle, continue to go before you actually push it back out. One of the things that I also want to talk about really quickly is that the house that you live in is not technically an asset because it's a liability, right? You're paying that rent. And we'll go into other videos in the detail about, let's take a step back and really understand that the house that you live in is not an asset because you're actually paying that rent. An asset flows cash, right? A liability sucks up that cash. So take a second to think about that. The house that you're living in right now, does it generate extra cash flow by itself? Well, it's not an asset if it doesn't. So just remember that as far as the understanding of wealth management and cash flow works, right? So let's also look at this as the metric that we were just talking about, right? So you have a job, it brings in cash, right? And you can purchase assets with that bring in more cash. So that basically takes you from a job, purchasing an asset, real estate, stocks, bond, things that flow in cash, right? And it brings you more income, right? In the sense of dividends, interest, return on investments, net operating income, royalties, whatever that means as far as income, right? But that asset also generates an expense. But because it's with a business, okay, a property can sit in this asset class and the expenses can sit in this asset class, and you just have this cyclical cycle of assets, expenses being taken away, and income coming back in. But that house that you buy, right, it's income, it jumps over here to a liability on the actual, your personal actual books, right? And it just draws that expense because at the moment, it's not technically bringing back in income. So think about that. And we really want to think about that when we come into this really unique opportunity that I'll really present you with, which is why not rent instead of buying a house? A lot of people, you hear that differently, but I'm going to show you a twist on that. But stick with me. The most important thing, right, is cash flow. So flow and cash is the most important thing. Cash is definitely king. So we also talk about wealth and building this matrix in the sense of using the money that you currently have today to generate an income that replaces that money so that you're essentially living off of that income. We want to think mailbox money, money that you don't have to do anything for, right? That may require you partnering with an asset manager. That may require you to partner with a property manager so that once a month you get cash flow in and they do all of the work and you pay them that 10%, that 8%, that 11% for that cash flow so that you can replenish your cash with net on the investment and you continue to go up this cycle of mailbox money. Now, let's take a look at that strategy that I was just referring to. So think about the first house that you buy, right? Think about the allowance when you were younger, right? Your parents used to give you $25, right? First thing you do, go buy a box of cookies and some ice cream, right? But let's think about that for the house as well too, because your income allows you to buy a certain amount of house, right? So let's take a look at how to find that out. One way to look at that is go to NerdWallet. NerdWallet has, and other sites as well too, have this very interesting calculator that will allow you to see how much your money can be used to purchase a home, but also just how much is your salary worth in a certain city. So if you're moving from city to city, try to understand what a $50,000 salary means in that city, right? What a $100,000 salary means in that city. $100,000 salary in California may not mean anything, right? You may need 2 incomes in order to purchase a house in California. You may need 3, right? So let's try to work on building that third income by utilizing the money that you have to purchase an asset that's flowing capital, right? If you purchase that asset with inside of a business and you co-sign on that loan for that house through that business, it allows you to flow capital, right? And because it's a business expense and a business asset, in 2 years, when you go to get your own mortgage on a house, the bank is going to see, okay, you're flowing capital from these other investments. We can give you another $200,000 loan and they won't even categorize or calculate that those other mortgages into your personal finances, right? So first off, make sure you're talking with your finance professionals about different strategies like this, right? Talk to your accountant, your CPAs, or understand it from the lawyer's perspective, understand it from a tax strategy perspective of how and what this really means for you. But think about it as an allowance. Don't go blow it on a cookie, right? One of the reasons why I'm actually talking to you about this is because it's something that I wish that I would have done early on, or something that I'm working towards right now, right? I went and bought my first house, right? $230,000. But what if I would have split that over 5 properties instead of 1 property? I could be flowing $300 in assets every month per property, paying those properties off within 5 years. Within 10 years, I could have paid 1 or 2 of those properties off and sped up that capital. We're going to talk about that in a second as well too. But understanding how much house you can buy. You don't necessarily have to blow it all on your first house. Understand that you can use that how much house you can buy on a secondary property that will actually flow you capital and cash. So think about it from that perspective and just chew on that, and let's talk about it, how it's going to work for you. So, but determine your strategy. Are you going to do short-term rentals? Are you going to Airbnb this? Are you going to rent it out? What is your strategy for doing this? The last thing you want to do is jump into this without a plan. So try to understand what it is and the angle that you want to go at it. Come up with a game plan and make sure that you are flowing capital from day one all the way up until the end. And remember, you don't have to live in this property. It needs to flow capital. Somebody needs to be in there, right? So we kind of already clued you in or about what happens if you bought 5 single-family homes or quadruplex with that same amount of money and using that same amount of down payment on a couple single-family homes and flowing that cash, right? So here's another thing. Where do you get the down payment for? You may be just starting off in life. You have no money in the bank account and you just got a new job. Well, guess what? Time is your best friend right now. Wait 6 to 12 months. Go and rent. Save up all the money that you possibly can for a down payment. It may take you 6 months, 12 months, 24 months to do that. But creative finance is going to be your friend. One way creative financing. You or your spouse are in the military, right? You can use that VA home loan. And instead of going and purchasing your own home, you can use creative financing to leverage it in this way. Say you only spend 6 to 12 months in that property a year, right? Make sure that you understand the rules, because with a VA home loan, you're supposed to stay in that thing for 12 months. So the address has to be yours, but there's ways to utilize creative financing in order to not be in that house for 12 months. We are working in a virtual environment, right? So if you need to go work in another place, they will understand and allow that. But make sure that you're legally within bounds to do the strategy that you're doing, and make sure that you take care of yourself. But creative financing, finding a way to pay that down payment is something that you're going to have to do some work to figure out how you can do it. It may take you a little bit of time to do it. All right, so let's quickly run through what it looks like if you were to take that 200 and let's call it $230,000 and purchase 5 homes. Maybe I think that comes out to maybe about $45,000 a home. But say it's a Section 8 market and you have a property manager that's going to take care of it, or say it's a quadruplex and you have a property manager that's going to take care of that, right? And you're flowing that cash flow, you don't really need as much as you think you need, right? So let's just take a look at what that looks like. Let's just say that this thing, on an annual cash flow basis, you flow $2,500 a month for 5 properties, right? That's, somewhere around $200 per property that you need to put into the cash flow machine and cycle. Well, you take those other 4 properties, right, and feed it into one property, and this is what it looks like. You're going to pay $15,900 within that first year if you own all 5 of those properties. Well, how long does it take you to pay that house off? 8 to 10 years, right? And then you take all the capital inside of that investment and you continue to do that cycle, and you push all of that money towards another property that you already own, right? That house is paid off in how long? How long do you think it's going to take you to pay it off? You think it's going to take you 10 years to pay that house off? No, it's going to take you 3 years to pay that house off. And then you turn around and you do that again, right? How long is it going to take you to pay one of those, the third house off? With that same amount of money, that same funnel, money flowing right into your next property. It's going to take you 2 years, right? So you just cut a 10-year process down to 3 years, a 3-year process down to 2 years. And how quickly do you think it's going to take you to pay off this 4th and this 5th property? Now, remember, in order to do this, right, we forewent purchasing our own big single-family property that we lived in. It's not considered an asset, that is considered a liability, and we'll go through those numbers in another video. But think about it, right? It would typically take you 65 years to do something like this if you were working in your typical life cycle of your employer, right? But it would take you 25 years to start generating cash flow income of what? About $200,000. 25 years, $200,000. You didn't purchase your own first home. But remember, 25 years has passed by. How many raises did you get at your new job? How many new jobs have you gone through over the course of 25 years, right? Does it take 25 years for this cycle to actually run? No, and I'll show you some different ways where it doesn't take 25 years for the cycle to actually run. Maybe you don't need $100,000, $200,000 annual income to kind of set yourself level playing field to go and do other things. Maybe instead of that third property, you purchase a multifamily complex that has 8 units, and you did this exact same thing. Right? Those are the type of things that we're talking about when we talk about generational wealth. Cash flow is very important. Understanding what your debt coverage ratio is extremely important, but more importantly, is not wasting the amount of money that you have, that you may not even understand that you have, to purchase not just one property, but multiple properties. If you take that step back and you evaluate the situation, evaluate how you can actually use that capital, evaluate what your strategies are going to be to actually come up with that down payment, how long it's going to take you. in all of this time period, what if you just rented an apartment complex? Because when you go and get that loan, they don't weight that apartment complex in the sense of you have a mortgage already, right? You don't have a mortgage already. They don't know that you're going to be renting out this apartment complex. They don't or this single family home, right? But use the tools around you, use the people around you, do your own research, talk to your professionals within the space, and understand what it is that you need to do to build your own generational wealth within inside of your own capability. There's a lot of things that you can do. But my name is Victor Robinson, and thank you for your time and allowing me to sit here and talk to you about this. I really look forward to answering any questions that you have. So please shoot them over my way, and we'll continue this conversation with any new topics that you have. So make sure you send me those topics, comment below, let me know your thoughts. Look forward to hearing from you soon. Have a good one.